The first half of 2024 has been bullish for markets. Meanwhile, we have some important milestones to hit in the second half of the year, such as the U.S. election and potential rate cuts. So how can investors best position themselves for the second half of 2024? Find out right now on UBS Trending. Hi, everyone, and welcome to another episode of UBS Trending. I'm Anthony Pastore. Thanks for joining us today. Jason Draho and Nadia Lovell are back in the studio to break down the latest from the Chief Investment Office, which is the second half market outlook piece that was just released. Jason and Nadia, good to have you here. Jason, I wanted to start with you. Obviously, the first half of the year has been really historic in a lot of ways, and we've had many conversations about that. And now we're looking at the back half as we're sitting here in late June. What are some of the highlights that are in this latest second half outlook report that we could kick off with here?
Well, we've had a decision time because clearly there's some obvious big decisions and big stories that we focused on in the report, and three in particular. One, first and foremost, is the U.S. election. It's coming up in a little over 4 months, and it's going to become an increasing focus as we move through the summer and to the fall. The implications for the economy, for the markets, so that's one factor. The second sort of decision is kind of for the Fed itself. What are they going to do with interest rates? Our expectations are going to cut starting in September, but that'll be a big debate as we move into later in the summer, the rest of the year, like what do they decide to do? And the third is kind of AI developments and sort of further progress there. So how will that continue to evolve? That's been a big driver for the markets for the past year. It will continue to be a big driver. The one thing that's sort of interesting about, and we said this in the second half outlook, is that in some way, a lot of these developments have more implications for 2025 and beyond than they do actually in the second half of the year. Like just think about the election. We won't actually have a new president or current president getting reelected, a new Congress until basically January. So no real policy changes until then. The Fed may not cut in until December, so the impact of that is not going to be felt really until next year as well. So a lot of discussion is almost like what things happen this year, in the second half of this year, what does it mean for the markets going ahead? In terms of what's sort of different, like first half, the market's been obsessed with the Fed itself. Certainly AI has been a big story. The election in some ways has been a real kind of back burner issue, but now as we move into the summer, it's going to sort of come front and center, become a big source of a minimum probably market volatility.
Right. Yeah, that's a really good point, Nadia. I'll bring this up with you. Jason mentioned market volatility. It seems like there is a lot of, a lot of debate and concern, or, you could name your adjective, but people have a lot to say about the U.S. election, whether you're sitting here in the U.S. or abroad. But certainly there is expectation that there could be some market volatility if there's a contested election. Who knows? But there are individual sectors also. So when you look at the election coming up in the U.S. overall, where do you say, here's what you should be focusing on, especially from the investment side?
Yeah, as you noted, and Jason noted that we're still a few months away from the election, and a lot can happen between here and then. But it feels like the prediction markets are assigning a higher probability to a potential Republican sweep than any other potential election outcome. Now, former President Trump's platform is one that's being built on higher tariffs, including potentially a 10% tariff across the board on all imports, and then also a potentially 60% tariffs from goods coming from China. Now we know that tariffs tend to be somewhat of a double-edged sword. It can benefit some companies and industries, but it can also not be so great for some others. So when we think about it, it could potentially benefit those manufacturing industries that are facing competitions from the likes of China. So that could include steel, aluminum, solar panel, and lumber. But at the same time, it could be a headwind to some of those companies and industries that really have their supply chain abroad. So think about some tech companies, some consumer discretionary, some industrial companies. And then also companies that derive a high portion of their revenues internationally could face the risk of potential retaliatory tariffs from some foreign governments. But outside of tariffs also, we do know that, Republicans tend to favor less regulations. And so those industries and sectors that are highly regulated, so energy and financials, could see some positive from that as well. And then you could see de-emphasis of some of the green initiatives that Republicans tend not to favor. And then also you could see less stringent enforcement of antitrust regulation. So that could be a positive for M&A, particularly large M&A. But Anthony, all that said and done, let's just be realistic. We do not advise investors to make any significant changes to their strategic asset allocation due to the looming election. We know that government policy and election is just one piece of the puzzle, right? Other factors impact, as Jason talked about, monetary policy, economic growth, corporate profits, all are going to matter. But we do think that volatility, like it typically does, will probably increase into the election. And historically, the data does not support any sort of significant performance difference based on who controls the White House or the broader government. But for investors who might be a little concerned about volatility, there's hedging strategies that can be put in place to really help navigate some of that.
Right. Clearly, a good conversation with your financial advisor will help to discover what's available to you in that hedging strategy that you're talking about, Nadia. Look, there's a lot to unpack, right? And so we're trying to all do this in less than 10 minutes. So, Jason, when it comes to the Fed now, I mean, moving off of the election, which has its own, kind of story and magnitude, we're looking at the Fed almost daily and figuring out what's their next move going to be based on rates, based on our economic data. And we just saw CPI come in a little bit lower than expected in the recent reading, and that gives kind of an indication that maybe inflation is coming under control. But there are lots of other factors out there. How do you think about interest rates as we get into the back half of the year, considering that the Fed is kind of indicating that they are probably going to cut at least once?
So we think interest rates are going lower, both in terms of the Fed funds rate, but also as a consequence, like say the 10-year Treasury, like kind of almost interest rates across the board should move lower. You alluded to inflation. The last print was surprise to the downside. So we have a couple of good months of inflation data. The Fed needs to see more or have greater confidence. It's not quite clear what exactly that entails, but let's say 3 more months of good sort of inflation data. Also, if there's any signs of the labor market cooling too much, kind of cracking to some extent, that will sort of precipitate the Fed to move more aggressively. We're saying they start cutting in September, but it's kind of a close call. It really depends on the data. It could be December. The Fed's sort of average, median forecast would be December, but again, if the data goes, they could sort of justify a September move. There is a November meeting. It's the day after the election, so no one kind of thinks it will happen the day after the election just because the optics looks bad. There's also debates whether they would wait until after November. I think they've always said we'll go if the data justifies it, but that is a consideration in the background. What you can see, there's a chart on the screen that shows, as essentially market pricing for where the Fed funds rate would go, as that's oscillated, you've seen the 10-year oscillate. So if that expectations for the Fed funds rate go lower, the 10-year is also likely to go lower. That's kind of a crux of our thesis. So rates going lower, that's where we think. We have a new message like position for lower rates. That applies kind of across the board, both in fixed income. What that really means is that now is really time to think about not just sitting in cash or money markets, but taking that and starting to deploy it into higher quality government bonds, municipals, corporate credits. We like mortgage-backed securities, CMBS, high quality that still have attractive yields. Because if interest rates go lower, you get the benefit of rates declining. So that's kind of a key thing is, don't wait for rate cuts to happen because in some way you've already kind of missed the train. You want to kind of join right now when there's still an opportunity when yields are at these levels to kind of lock in that. Otherwise, you're going to be reinvesting at a lower rate later on.
Terrific, Jason. Thank you. Nadia, I have to also, before we wrap, I have to ask you about artificial intelligence. It's the other big theme of 2024 so far, a lot of 2023 as well. We have that magnificent 7, the mega cap stocks that have done really well because they're AI connected. What do you think the next group of AI beneficiaries is going to be when you look at the overall market?
Thank you, Anthony. To let you in on a secret, might be my avatar sitting here right now. But AI definitely is a dominant theme this year, and we think that is going to remain that way for years to come. There's a lot of capital investment in the space, really, to build out the AI infrastructure. You have the 4 largest hyperscalers, those cloud computer providers that are expected to spend over $200 billion in CapEx this year, and much of that is going to go to AI. And when when you think about it over the next several years, by 2027, most of the data center capex is likely, about over 70% of it is likely going to be towards AI. And so we think that is going to be a dominant theme. We like to think about AI investing opportunity in three buckets. So one is that enabling layer. So sort of the picks and shovels to build out that AI infrastructure. So think about semis, data centers, some of the power supply companies. And then the next layer is the intelligent layer. So the large language models and the training of those models. And then that last top level is really sort of the application layer. And so the actual use cases, including my avatar, of AI. Right now we're really focused on that first enabling layer, and particularly on semiconductors. But we think that the broader now will happen and is starting to happen. And so other companies that are positioned to benefit are really software companies, data centers, cloud computer providers, some industrials, as well as utility companies. At the end of the day, we think that this is going to be a business of scale. So the large are going to continue to get larger. And we think that it's important for our investors to have exposure across that AI opportunity stack that we think that, by the time you get to 2027, could be an over $1 trillion revenue opportunity. And so we think that it's important to have exposure across the space.
Yeah, your avatar notwithstanding, so we see that there is incredible growth even from where I think a lot of investors are asking the question, have we hit the peak? But it sounds like there's a lot more room to go when it comes to this AI and AI-related story.
Absolutely. Tremendous runway still ahead. We think that this is going to be the theme of the decade.
Great.
And investors can't afford to really miss out on it.
Great opportunities there. Thank you both for joining me for this conversation. Good to have you both, Jason and Nadia, and thank you all for joining us as well. For more information on anything we spoke about today, visit our Insights website at ubs.com/views. That is access to our Chief Investment Office publications, plus lots of other content. Plus, you can make sure to follow UBS on social media. We're on all the major channels, including our Instagram channel at UBS Trending. We've got studios content there that you're not going to find anywhere else. And as always, if you have any questions about your portfolio, make sure you're talking with a financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon.